Before we begin, please remember that I am not a licensed financial advisor, mortgage broker, or real estate agent. The information provided in this video is for educational and informational purposes only. It is not intended to be a substitute for professional financial advice. You should always consult with a qualified professional before making any major financial decisions, especially those concerning a home loan. Your financial situation is unique, and the information presented here may not be suitable for your specific circumstances. You've been told a lie that is costing you thousands of dollars a year and keeping you from building real wealth for your family. It's a lie that echoes in the back of your mind every time you write that rent check, watching your hard-earned money vanish into your landlord's bank account instead of building your own equity. The lie is this: that your credit score, specifically a score around 600, is a permanent barrier, a giant unbreachable wall standing between you and the dream of owning your own home. You see your friends buying houses, you scroll past the happy announcements on social media, and you feel a pit in your stomach thinking, "That can't be me. My credit isn't good enough." You feel stuck, trapped in a rental cycle where the rent goes up every single year, but your control over your own living space stays at zero. You dream of a backyard for the dog, a safe street for your kids to play on, the simple freedom to paint a wall whatever color you want without asking for permission. You dream of stability, of a fixed mortgage payment that doesn't unexpectedly jump by $200, and the pride of knowing that every payment you make is an investment in your own future. Well, today, right now, we are going to tear down that wall. I'm going to prove to you that the lie you've been told is just that, a lie. In this presentation, I'm not just going to tell you that it's possible to get a home loan with a 600 credit score in the United States. I'm going to hand you the exact playbook. We will break down the specific, government-backed loan programs designed for people just like you. I'm going to expose the hidden requirements and the secret flexibility that most lenders won't even mention unless you know the right questions to ask. And most importantly, I'm going to walk you through the critical yet common mistakes that get people with fair credit in instant denial and how you can avoid them. By the end of this video, you won't just have hope. You'll have a clear, actionable plan to go from renter to homeowner, even with a credit score that you thought was holding you back. So let's get right into it. What even is a 600 credit score? In the world of lending, it's like having a C or C- on your financial report card. It's not failing, but it's not exactly making the honor roll either. Lenders see this number and they immediately place you in a category they often call fair credit or, in more direct industry terms, subprime. That word, subprime, probably makes you cringe. It brings back memories of the 2008 financial crisis and news reports of risky loans. But here's the first truth you need to understand. Subprime doesn't mean impossible. It just means the lender sees you as a higher risk. And when a lender sees risk, they do two things. They get nervous and they look for reasons to say no. Your job is to give them every reason to say yes. And to do that, you have to understand what they're actually looking at. That 3-digit number, your FICO score, isn't just pulled out of thin air. It's a complex algorithm based on 5 key factors from your credit report. 35% of your score is your payment history. It's the king. Have you paid your bills on time every time? A single 30-day late payment can crush your score. The next 30% is your credit utilization, or how much of your available credit you're using. If you have a credit card with a $10,000 limit and you have a $9,000 balance, you're using 90% of your credit. That's a massive red flag to lenders. It signals that you might be overextended and financially stressed. 15% is the length of your credit history. The older your accounts are, the better. 10% is your credit mix. Do you have a healthy mix of different types of credit, like a car loan, student loans, and credit cards? And the final 10% is new credit. Have you applied for a bunch of new credit cards or loans recently? Every time you do, it creates a hard inquiry on your report, which can temporarily ding your score and make lenders think you're desperate for cash. A 600 score tells a lender that there are some bruises on your report. Maybe you had a tough time a few years ago and missed some payments. Maybe you've relied a little too heavily on your credit cards to make ends meet. It tells a story of some past financial struggles. But here's the secret. Lenders are not just reading the headline number. A good underwriter, the person who actually makes the final decision, reads the whole story. And your story is much more than just that one number. They're looking for what we call compensating factors. These are the positive elements in your financial life that can outweigh the risks suggested by your credit score. Things like a stable job history. Have you been with the same employer for 2 or more years? A solid income. A low debt-to-income ratio, meaning your monthly debt payments are a small percentage of your gross monthly income. And a down payment. Cash is a powerful compensating factor. This is where the game changes. You need to stop thinking of yourself as a victim of your credit score and start thinking like a strategist. Your application isn't just a form. It's a proposal. You are proposing to the bank that you are a reliable person who will pay back a very large loan on time for the next 30 years. Your 600 credit score is a weakness in that proposal, so you need to make every other part of it as strong as humanly possible. Now, how do you do that when most big banks have automated systems that might automatically reject an application with a score below, say, 640 or 620? This is where you need to know about the most powerful tool available for homebuyers with fair credit in America: the FHA loan. FHA stands for the Federal Housing Administration. It is not a lender. The FHA doesn't give you money. What they do is provide insurance to the lender. They essentially tell the bank, hey, go ahead and lend money to this person. If they default on the loan and you lose money, we, the US government, will cover your losses. This insurance dramatically reduces the risk for the lender, which makes them far more willing to approve someone they might otherwise consider too risky. It's the government's way of encouraging homeownership and helping people who don't have perfect credit or a huge 20% down payment. And here is the single most important piece of information I can give you. According to the FHA's own official guidelines, the absolute minimum credit score they will insure is 500. Let me repeat that. The official FHA minimum is a 500 credit score. If your score is 580 or higher, you can qualify for their flagship program with only a 3.5% down payment. So if the official minimum is 500, why does everyone, maybe even a lender you've spoken to, tell you that you need a 620 or a 640? Why is there such a massive disconnect between the official government rule and what happens in the real world? The answer is a little-known industry term that is the key to unlocking your home loan. It's the one thing that separates the lenders who will instantly deny you from the ones who will welcome your application. This concept is called lender overlays, and understanding what they are, why they exist, and how to find the lenders who don't use them as strictly is the difference between staying a renter and getting the keys to your new home. So what exactly is a lender overlay? Think of it like this: the government, through programs like the FHA, sets the absolute minimum passing grade for a home loan. Let's say they decide a D-, a 580 credit score, is technically passing. That's the official rulebook. But then you have the lender, the bank, the credit union, the mortgage company, who is actually giving you the money. They look at the government's D- rule and say, that's nice, but in our school you need at least a B+, a 640, to even sit in our classroom. That extra requirement, that jump from a 580 to a 640, is the lender overlay. It's their own private, internal rulebook stacked right on top of the government's official one. And this is the secret that trips up almost everyone. You read online that the FHA allows for a 580 credit score, you check your own score and see a 600 and you think, great, I qualify. You walk into a big national bank, the one you've had a checking account with for 10 years, you apply with confidence, and you get a denial letter a week later. It's crushing. You feel like you were lied to, but you weren't lied to about the government's rules. You were just completely unaware of the bank's secret, unwritten ones. Why do they do this? Why create these extra hurdles? It boils down to one word: risk. Lenders are not charities, they are businesses. Their job is to lend money and make a profit from the interest. A foreclosure is a catastrophic loss for them. Yes, for loans like an FHA loan, the government provides insurance to the lender to protect them if you default. But that insurance doesn't cover everything. A foreclosure is still a messy, expensive, and time-consuming process. It costs them legal fees, administrative headaches, and can damage their reputation with the very investors who provide them with the money to lend in the first place. So, they create overlays as their own personal insurance policy. They analyze mountains of data and decide that, based on their past experiences, lending to someone with a 600 score is just too risky for their specific business model. They've determined that applicants with a 640 score or higher are significantly more likely to pay their mortgage on time, every time. It's not personal. It's a cold, hard statistical calculation designed to protect their bottom line. The government is willing to insure the riskier loan, but the lender themselves isn't willing to take on the initial hassle. They'd rather just say no upfront and wait for a less risky applicant to walk through the door. And this doesn't just apply to your credit score. Overlays can pop up in every single corner of your application. Let's look at the most common ones. First, there's debt-to-income ratio, or DTI. This is a huge one. Your DTI is the percentage of your gross monthly income that goes towards paying your monthly debts. Things like car payments, student loans, and credit card payments. FHA guidelines are actually quite generous here. They can often go up to 50%, sometimes even higher in certain circumstances. This means half of your pre-tax income could be going towards debt, including your new mortgage payment. But many large lenders will put an overlay on this. They'll cap the DTI at 45%. So you could have a 680 credit score, a great income, a solid down payment, but if your total debt, including the new house payment, puts you at a 47% DTI, you get an instant denial. You met the government's rule, but you broke the bank's. Another massive overlay is cash reserves. Cash reserves are the funds you have left in your bank account after you've paid your down payment and all your closing costs. It's your emergency fund. For a standard FHA loan, the official government guideline often doesn't require any reserves at all. As long as you can cover the initial costs, you're good to go. But a lender might have an overlay that says, we require all borrowers to have at least 2 months of mortgage payments saved up after closing. So if your mortgage payment is going to be $2,000 a month, they want to see an extra $4,000 sitting in your checking or savings account on closing day. If you've scraped together every last penny just to cover the down payment, this overlay will stop your application debt in its tracks. Let's think about a real-world example. Meet Sarah. Sarah is a 32-year-old graphic designer. A few years ago, she had a medical emergency that led to some late payments and a collection account, tanking her credit. She's worked hard to fix it, paid off the collection, and has her score up to a solid 605. She's been at her job for 3 years, has a stable income of $60,000 a year, and has diligently saved up $12,000 for a down payment on a small condo. She does her research. She sees FHA loans available for scores as low as 580. She sees that her $12,000 is more than enough for the 3.5% down payment. She calculates her DTI, and it comes out to 48%, which she read is acceptable for FHA. She's excited. She feels ready. She makes an appointment at the giant household name bank on the corner, the one whose commercial she sees during the Super Bowl. She sits down with the loan officer, hands over all her documents, and feels a surge of pride. A week later, she gets a thin envelope in the mail. It's a generic form letter denial. The reason cited is vague. Credit score does not meet our minimum requirements, and excessive obligations in relation to income. Sarah is devastated. She thinks, it's over. I'll never be a homeowner. My 605 score just isn't good enough, no matter what the internet says. But Sarah's wrong. Her 605 score was good enough. Her 48% DTI was acceptable. The problem wasn't Sarah. The problem was the lender she chose. That big bank had a set of overlays that acted like an invisible wall. Their internal rules, which were never explained to her, likely required a minimum 640 credit score and a maximum 45% DTI. Sarah was being judged against a scorecard she never even knew existed. She was disqualified before she even sat down. Overlays can get even more specific. Some lenders have overlays on employment. FHA might be fine if you just switch jobs to a new company but stayed in the same industry. But a lender might have an overlay requiring 2 full years on the exact same job. FHA might not require you to pay off old, small medical collection accounts. But a lender might have an overlay that says all collections, no matter the type or amount, must be paid in full before they'll even look at you. This is why the home loan process feels so confusing and contradictory. It's because you're playing 2 different games at the same time. You're playing the government's game with its official published rules, and you're playing the lender's secret game with its invisible, constantly changing overlays. And for someone with a credit score in the low 600s, or even the mid 600s, understanding this distinction is everything. It's the key that unlocks the entire puzzle. Your journey to homeownership is not about changing yourself to fit the rules of one specific bank. It's about finding the bank whose rules already fit you. The denial letter Sarah got from that big bank felt like a final judgment on her worthiness as a borrower. But it wasn't. It was just a data point. It was information. It told her that this specific lender, with its low-risk, conservative business model, was not the right partner for her. It didn't mean no lender would be. This should fundamentally shift your entire mindset. You are not a bad applicant begging for a loan. You are a customer shopping for a product. If you walked into a Lamborghini dealership and they told you couldn't afford a car, you wouldn't give up on driving forever. You'd go to the Toyota dealership down the street. The same principle applies here. The big, national banks are like the luxury high-end dealerships. They can be extremely picky because they have a line of perfect 800 credit score customers waiting outside. They can afford to have strict overlays because it makes their job easier. But they are not the only game in town. There are other types of lenders, mortgage brokers, direct lenders, credit unions, who have specifically designed their business model to work with the exact FHA guidelines, without adding all those extra, restrictive layers on top. Their school is perfectly happy to accept the D- that the government says is a passing grade. So the question is no longer, can I get a loan? The real question is, where do I find the right lender for me? How do you find the lenders who don't use these punishing overlays? The ones who look at your 600 credit score, your 48% DTI, and your hard-earned down payment and say, yes, we can make this work. Finding them is the single most important part of this process, and it requires a strategy. It's time to stop walking into the wrong dealerships and start finding the ones that actually want your business. And in the world of mortgages, the wrong dealership is almost always the place you think of first. It's that giant national bank on the corner. The one with the familiar logo you see on every commercial and ATM. You might even have your checking account there. So you walk in feeling a mix of hope and dread. Sit down with the loan officer and hand over your life on a few pieces of paper. And then a few days later you get the call. Or worse, the cold, impersonal email. Unfortunately, at this time, it's a gut punch. You feel defeated. You feel like if they can't help you, nobody can. But here's the secret they will never tell you. That bank didn't reject you because you're not worthy of a home loan. They rejected you because you didn't fit into their tiny pre-approved automated box. Big national banks are like factories. They are designed for one thing: efficiency at a massive scale. They want the easiest, most straightforward, highest credit score applications they can find. They build their entire system, their software, their underwriting process around a hypothetical perfect borrower. This system is often called an AUS, or automated underwriting system. It's a computer algorithm. It looks at your 600 credit score, doesn't see a 740, and the computer says no. There's very little room for human intervention for context for your story. The loan officer you spoke to might be a great person, but their hands are tied. They can't fight the algorithm. They just fed your numbers into the machine, and the machine spit out a denial. You weren't a person to them. You were a data point that didn't compute. Walking into that bank with a 600 score is like trying to buy a custom-built racing engine at a Walmart. They don't sell it. It's not their business model. So where are these dealerships that actually want your business? Where are the lenders who specialize in custom engines? They exist in three main places, and understanding them is the key that unlocks the entire game. First, and most importantly, is the independent mortgage broker. Write this down. A mortgage broker is your secret weapon. They are the ultimate insider. Unlike the loan officer at the big bank who works for the bank, a mortgage broker works for you. They don't have just one set of rules or one product to sell you. Instead, they have relationships with dozens, sometimes over 100 different wholesale lenders. These are lenders you've never heard of. Lenders that don't have public-facing branches or spend millions on TV ads. Their entire business is working through brokers. Think of it like this. The big bank is a restaurant that only serves one thing on the menu: a plain cheeseburger. If you want a vegan burger, a gluten-free bun, or extra bacon, they can't help you. A mortgage broker, on the other hand, is like a food critic who knows every single restaurant in the city. They know the one that makes the best vegan burger, the one with the secret off-menu items, and the one whose chef is willing to customize a dish just for you. You tell the broker your situation, your 600 score, your income, your down payment, and they go to work shopping your loan application to all these different lenders to find the one whose menu, whose specific guidelines are the perfect fit for you. One lender might have a strict 620 minimum score. No exceptions. The broker crosses them off the list. Another might be fine with a 580 score, but requires you to have 3 months of cash reserves in the bank. The broker checks if you have that. A third lender might not care about a medical collection from 2 years ago and has a special program for self-employed borrowers. The broker knows this. They are matchmakers. They find the lender who is actively looking for a borrower just like you. And the best part? In most cases, you don't pay the broker a dime out of your pocket. They get paid a commission by the wholesale lender that ultimately funds your loan. Their success is tied directly to your success. They don't get paid unless you get the keys to your house. They are your personal advocate, your guide through the mortgage maze. The second place to look is at direct lenders who specialize in government-backed loans. These are companies, often not traditional banks, that have built their entire business around FHA, VA, and USDA loans. Because this is their specialty, they are experts. They understand the nuances and, crucially, they often have fewer lender overlays. An overlay is a key term you need to know. The FHA, for example, might say, "We will insure a loan for a borrower with a credit score as low as 580. That's the government's base guideline. But a big bank might say, "That's nice, but our rule, our overlay, is that we won't lend to anyone with a score below 640. They add their own, stricter rule on top of the government's minimum. They do this to reduce their risk. But these specialized lenders often have fewer or no overlays. They are willing to lend right down to the government's actual minimums. They've built their business model around helping the exact type of borrower that the big banks turn away. Third, don't overlook your local credit union. Credit unions operate on a completely different philosophy than big banks. They are nonprofits owned by their members. That means their primary motivation isn't maximizing profit for shareholders. It's serving their members. If you have an established relationship with a credit union, a checking account, a car loan, they are far more likely to look at you as a whole person, not just a credit score. They have more flexibility and sometimes offer what are called portfolio loans. This is where they lend their own money and keep the loan on their own books instead of selling it. This gives them the power to make their own rules and make exceptions for members they believe in. It's not a guarantee, but a conversation with the loan officer at your local credit union is always worth your time. Okay, so now you know who to look for. Mortgage brokers, specialized direct lenders, and credit unions. But how do you actually find them? This isn't a passive process. You need to become an active, educated hunter. First, for mortgage brokers, start by asking for referrals. Call a few of the top producing real estate agents in your area. Ask them, who is the broker you call when you have a tough file? Who is the one that gets deals done that other lenders can't? Realtors know. Their commission depends on the loan closing, so they have a vested interest in working with brokers who are miracle workers. You can also do a simple online search for mortgage broker in your city or FHA loan specialist near me. But don't just pick the first name you see. You need to interview them. This is where you flip the script. You are not begging them for a loan. You are interviewing them for the privilege of handling the single largest financial transaction of your life. Get on the phone and ask them these critical questions. What percentage of your closed loans are FHA loans? If they hesitate or say a low number, they're not the expert you need. Have you successfully closed loans for borrowers with credit scores under 620 in the past 3 months? You want someone who is in the trenches doing this every single day. And the killer question: can you tell me about the different lender overlays you encounter for borrowers in my situation? A great broker will immediately be able to talk about which of their lenders are lenient on debt-to-income ratios, which ones ignore medical collections, and which ones have the lowest score requirements. Their answer to this question will tell you everything you need to know about their expertise. You are no longer a victim of the process. You are the CEO of your home buying journey. You are building a team, and your first hire is a world-class mortgage professional who specializes in your exact situation. This isn't just about finding someone who will say yes. It's about finding the right partner who will give you the right advice, find you the best possible terms, and guide you across the finish line. Forget the big banks that made you feel small. Your journey to homeownership starts by finding the expert who sees your potential, not just your past. And once you have that expert on your team, the next step is to match your story to the perfect loan program. Because with a 600 credit score, the type of loan you apply for is everything. Think of the mortgage world as a series of doors. With an 800 credit score, almost every door is unlocked. But with a 600 score, most of those doors are shut, bolted, and have a big "no trespassing" sign on them. But here's the secret. There are other doors. Special doors. Doors that were specifically built for people just like you. And your mortgage expert's job is to hand you the keys to those doors. These aren't back doors or side entrances. They are powerful government-backed programs designed to build the middle class and reward those who serve. They are the great equalizers in the home buying game. Let's break down the 3 most important ones you need to know about. First up, the heavyweight champion of second chances, the FHA loan. FHA stands for the Federal Housing Administration, and their loan program is probably the single most important tool for first-time homebuyers in America, especially those with bruised credit. The FHA isn't actually lending you the money. Instead, they're essentially co-signing for you. They go to the bank and say, "Hey, we've got your back on this one. If this borrower for some reason can't pay, we'll cover your losses." This insurance for the lender is what makes them willing to say yes to a 600 credit score. So what does this mean for you? It means the credit requirements are incredibly flexible. The official FHA guideline says you can get a loan with a credit score as low as 580 with just a 3.5% down payment. Let that sink in. On a $300,000 house, that's $10,500 down, not the $60,000 you might think you need. And technically, the FHA even allows for scores between 500 and 579, as long as you can put 10% down. Now, a word of caution. Lenders can add their own internal rules called overlays, so some might still want to see a 600 or a 620. But the FHA program itself is built for this exact scenario. It's designed to look beyond the number and at the bigger picture. But like anything in life, there's a catch. And it's a big one you need to understand. That insurance the FHA provides to the lender, you're the one who pays for it. It's called MIP, or mortgage insurance premium. Comes in two parts. First, there's an upfront premium, which is a percentage of your loan amount that usually gets rolled right into your mortgage so you don't pay it out of pocket. Second, and this is the one you'll feel every month, is the annual premium, which is paid in monthly installments as part of your mortgage payment. For most FHA loans today, this monthly mortgage insurance lasts for the entire life of the loan, unless you put down 10% or more, in which case it lasts for 11 years. This is the trade-off. You get access to homeownership with a lower score and a small down payment, and in exchange you pay an extra fee each month that protects the lender. The FHA loan is your foot in the door. It's the opportunity to start building equity and stop paying rent. For many, it's not their forever loan, but it's the perfect right now loan. Next, let's talk about what is, without a doubt, the single best mortgage product on the planet if you qualify. The VA loan. This loan is reserved for a special group of people. Eligible veterans, active duty service members, and some surviving spouses. It was created after World War II as a way for the nation to say thank you to those who served. And it's not a handout. It's a benefit that has been earned through sacrifice. If you think you might be eligible, you need to stop everything and look into this. Why? Two unbelievable reasons. 0% down. You can buy a home with absolutely no down payment. And second, no monthly mortgage insurance. Let me repeat that. With a VA loan, you don't have to save for years to scrape together a down payment, and you don't have that extra monthly MIP payment that comes with an FHA loan. This can save you hundreds of dollars every single month. The Department of Veterans Affairs guarantees a portion of the loan, similar to the FHA, which gives lenders the confidence they need. And because of that strong government guarantee, lenders are often very flexible on credit scores for VA loans. A 600 score is very much in the realm of possibility for a VA approval. Now, what's the catch here? Well, instead of mortgage insurance, there's something called a VA funding fee. It's a one-time fee that helps keep the program running for future generations of service members. The exact percentage varies based on your service, your down payment amount, and whether it's your first time using the benefit. But here's the key. For most borrowers, this fee can be rolled directly into the loan amount. And importantly, veterans receiving VA disability compensation are typically exempt from the funding fee entirely. The VA loan is a testament to a promise kept, offering a direct and powerful path to homeownership for those who have worn our nation's uniform. Finally, let's talk about the hidden gem of the mortgage world, the USDA loan. USDA stands for the United States Department of Agriculture. And I know what you're thinking. I'm not a farmer, I don't live on a farm. That's the biggest misconception out there. This program isn't just for farms. It's designed to promote homeownership in less densely populated areas. And you would be shocked at what the USDA considers rural. We're talking about small towns and suburbs outside of major metropolitan areas all across the country. There are eligibility maps online where you can type in an address and see if it qualifies. 97% of the landmass in the United States is in a USDA-eligible area. If you find a home in one of these areas, the benefits are incredible. Just like the VA loan, the USDA loan offers 0% down payment, 100% financing. It's another program designed to remove that massive hurdle of saving for a down payment. The credit score requirements are also flexible, with many lenders working with scores in the low 600s, though the official USDA guideline is typically 640 for their automated underwriting system. A good loan officer can often work with scores below that through manual underwriting, where a real person reviews your entire file. So, what are the catches with this hidden gem? There are two main ones. First, the property has to be in an eligible geographic area. Second, you, the borrower, have to meet certain income limits. This program is designed for low to moderate income households, so you can't make too much money. The income caps vary by county and family size, so you have to check the limits for your specific area. And similar to FHA, there is a form of mortgage insurance, a one-time guarantee fee that's rolled into the loan and a small annual fee paid monthly. But for the right person in the right location, the USDA loan is an absolutely life-changing opportunity. So you have the FHA, the comeback kid, the VA, the hero's reward, and the USDA, the path less traveled. These are your primary options. What about a conventional loan, the one you always hear about? With a 600 score, a conventional loan is going to be tough. The absolute minimum score for most conventional lenders is 620. They don't have that same government guarantee, so they rely much more heavily on your credit score to predict risk. Getting an approval at 620 is hard enough. At 600, it's nearly impossible. Think of the conventional loan as the goal for the future. You use an FHA loan to get into your first house, spend a few years making on-time payments, watch your credit score rise, and then you refinance into a conventional loan to get rid of that FHA mortgage insurance. Choosing the right program is like a chess move. It's a strategic decision based on your unique story, your credit, your military service, where you want to live, and how much you have saved. Each one offers a different path to the exact same destination. A front door with your name on the mailbox. But knowing which path to take is only half the battle. Because even with a zero-down loan from the VA or USDA, or a low-down FHA loan, buying a house still costs money. Real money out of your pocket that you need on closing day. We're talking about closing costs, prepaid expenses, and earnest money deposits. So where on earth does that money come from? How do you come up with thousands of dollars when you're already stretching to make it work? Well, there are secrets to that too. And that's exactly what we're going to break down next. The down payment. The closing costs. It's the great wall that stands between so many people and homeownership. For most, it feels like an impossible amount of money to save. We're talking $5,000, $10,000, $20,000 or more. When you have a 600 credit score, you're often focused on just managing your monthly bills, not building a massive savings account. The system seems designed to keep you out. But what if I told you the system also has secret backdoors? Hidden passages designed specifically for people in your exact situation. These aren't loopholes or sketchy tricks. They are legitimate, powerful programs that millions of homeowners have used to bridge that gap from renter to owner. The problem is, most people have never even heard of them. The most powerful secret weapon in your arsenal is something called down payment assistance, or DPA. Think of it as a scholarship, but for buying a house. These are programs usually run by state, county, or city governments, created with one goal in mind: to help you cover the upfront costs of a mortgage. And they come in a few different flavors, some of which are frankly mind-blowing. The first, and the absolute holy grail, is the grant. This is the simplest and best kind of help you can get. A grant is a gift. It's free money. You get it, you use it for your down payment or closing costs, and you never ever have to pay it back. It's like finding a $5,000 winning lottery ticket on the sidewalk right when you need it most. These programs exist. They are real. And they can completely change the game for you. Imagine needing $8,000 for your down payment, and a local housing authority just gives it to you. That's a grant. Now, the second type is almost as magical, and it's far more common. It's called a forgivable loan. This is where it gets really interesting. A government agency gives you a loan for, say, $10,000 to cover your costs. It's technically a second mortgage on your home, which sounds a little scary, but here's the magic trick. You don't have to make any payments on it. And if you live in that house as your primary residence for a set period of time, let's say 5 years, the loan is completely forgiven. It vanishes. Poof. It disappears into thin air as if it never existed. Let me paint a picture for you. Let's say you're buying a $200,000 house. Your FHA down payment is 3.5%, so that's $7,000. You find a state DPA program that offers a forgivable loan of up to 4%. That's $8,000. They give you that money. It covers your entire down payment, and you even have $1,000 left over for closing costs. You move into your house. You make your regular mortgage payments for 5 years. On the 5th anniversary of you living in that home, that $8,000 loan is wiped off the books forever. You did nothing but live in your own home, and in return you were gifted $8,000. This is one of the single greatest wealth-building hacks available to the American public, and it is tragically underutilized. The third type is a deferred payment loan. This is another brilliant solution to the immediate cash problem. With this program, you get a loan for your down payment, and you don't have to pay it back until you sell the house, refinance the mortgage, or pay off your primary loan, which could be 30 years down the road. There are no monthly payments. It just sits there silently until you're in a much better financial position. It's like kicking the can down the road in the best way possible. It solves the immediate massive hurdle of coming up with thousands of dollars today, allowing you to get into the house and start building equity now. You're using the future value of your home to pay for the entry ticket to homeownership itself. So where do you find these magical programs? It's not as hard as you think. Your first stop should be to search online for your state's housing finance agency. Every state has one. Go to their website. There will be a section for homebuyers, and right there you will find a list of the DPA programs they offer. But don't stop there. The real gold is often buried at the local level. Search for your city down payment assistance or your county first-time homebuyer program. You will be shocked at what you find. These hyperlocal programs are often less competitive and tailored to the specific needs of your community. Let me tell you about Sarah. Sarah was a dental hygienist with a 610 credit score. A few late payments on a credit card during a tough year, and an old medical bill she was still paying off had damaged her score. She was approved for an FHA loan to buy a small condo for $220,000. She was thrilled until she saw the numbers. The 3.5% down payment was $7,700. The estimated closing costs were another $5,000. She needed over $12,000 in cash. She had about $4,000 saved. She felt that familiar sinking feeling of defeat. Felt impossible. But her loan officer, a good one, told her to look into a city-specific program. She did. And she found one. It was a forgivable loan for up to $10,000 for essential workers, which included healthcare professionals. The only major conditions were that her income had to be below a certain threshold, which it was, and she had to live in the condo for 7 years. She applied and she got it. That $10,000 covered her entire down payment and most of her closing costs. She only had to bring about $2,000 to the closing table. 7 years later, that $10,000 loan will simply cease to exist. Sarah went from thinking she was years away from owning a home to holding the keys in less than 60 days. Now you might be thinking, what's the catch? Is this too good to be true? The catch is that these programs have rules. There are almost always income limits. They're designed for low to moderate income families. And often you're required to take a homebuyer education course. But let's be honest, that's not a catch, that's a benefit. It's a free class on how to successfully manage the biggest financial asset of your life. These programs exist because homeownership stabilizes communities. When people own their homes, they invest in their neighborhoods, they support local businesses, and they build generational wealth. The government isn't giving you a handout. It's making a strategic investment in you and in the community. But what if you don't qualify for a DPA program, or it doesn't cover everything? There is another secret passage. It's called gift funds. FHA, VA, and even some conventional loan programs explicitly allow your entire down payment to come from a gift. This is a massive piece of the puzzle that so many people miss. They think they have to save every single penny themselves, that it has to come from their own sweat and toil. That's simply not true. The money can be a gift from a family member, a parent, a grandparent, a sibling. It can even come from a close friend in some cases. The key is that it must be a true gift, not a loan in disguise that you have to pay back later. To prove this, the person giving you the money will have to sign a simple document called a gift letter. It's a one-page form that says, "I am giving this person X amount of money. It is a gift, and there is no expectation of repayment." They'll also need to show where the money came from, usually with a bank statement, to prove it wasn't some sort of illicit cash deal. Think about the power of that. Maybe your parents can't give you $10,000, but maybe they can give you $3,000. Maybe you've saved $5,000, a DPA program gives you another $7,000, and a gift from your grandmother for $2,000 gets you over the finish line. This is how it really gets done. It's not about one single solution. It's about stacking these strategies. It's a mosaic. A little bit from your savings, a piece from a DPA grant, and another piece from a family gift. Suddenly, that insurmountable wall of cash becomes a series of small, manageable steps. You've been led to believe that saving up a massive down payment is a test of your worthiness, a trial by fire you must endure alone. It's not. The system has built-in support mechanisms. The challenge isn't just saving the money. It's discovering the tools that are already there, waiting for you to use them. So now you know the secrets to conquering the down payment. You have a roadmap to find thousands of dollars you didn't know were available. But solving the money problem is only half the battle. Because now you have to face the gatekeepers themselves, the lenders. And this is where most people with a 600 credit score make their biggest, most fatal mistake. They think all lenders are the same. They're not. The lender you choose can be the difference between getting the keys and getting a soul-crushing rejection letter, even with the exact same financial profile. The secret isn't just if you can get a loan, it's who you get it from. And most people choose wrong. So let's pull back the curtain on the world of lending, because it's not one big, monolithic entity. It's a battlefield of different players, each with their own rulebook, their own appetite for risk, and their own definition of the perfect borrower. And for someone with a 600 credit score, you're not what they consider perfect. You're a story, and you need a lender who is willing to read past the first page. First, you have the Goliaths, the big national banks, the names you see on skyscrapers and Super Bowl commercials. Wells Fargo, Chase, Bank of America. When most people think mortgage, they think of the bank where they have their checking account. Feels safe, familiar. And that is the first and often most fatal mistake. These institutions are like massive cruise ships. They are powerful, they are huge, but they turn incredibly slowly and they can only dock at the biggest, deepest ports. They are not built for nuance. Their business model is built on volume and standardization. They want the easiest, cleanest, most straightforward loans possible. What the industry calls A-paper. They're looking for 740 credit scores, 20% down payments, and W-2 employees with 20 years at the same company. Why? Because it's simple. Their underwriters have to process thousands of files. They use automated systems, computer algorithms that scan for red flags. And a 600 credit score is a giant, flashing, crimson red flag to their system. It doesn't matter if that 600 is because of a single medical collection from 3 years ago that you didn't even know about, or if it's from a pattern of late payments. To the algorithm, 600 is 600. The loan officer you talk to, as nice as they may be, often has very little power. They are a customer service representative, not a decision maker. They plug your numbers into the computer, and the computer says yes or no. Going to a big bank with a 600 score is like bringing a knife to a gunfight. You are playing a game that is rigged against you from the start. They are not looking for a reason to say yes. Their entire system is designed to find a reason to say no, to mitigate risk at all costs for their shareholders. Next up, you have the credit unions. These are often seen as the friendlier, more community-focused alternative. And sometimes they are. Because they are member-owned, they don't have the same shareholder pressure as the big banks. They might be more willing to look at you as a person, especially if you have a long history with them. They might offer what's called a portfolio loan, which is a loan they keep on their own books instead of selling it. This gives them more flexibility with the rules. However, don't be fooled into thinking it's a guaranteed yes. Many credit unions, especially the larger ones, have adopted underwriting standards that are just as strict as the big banks. They might be a slightly smaller cruise ship, but they're still not a nimble speedboat. It's a better option to explore than a megabank, a definite step in the right direction, but it's still a coin toss. You're relying on their specific internal policies and maybe, just maybe, getting a loan officer who is willing to go to bat for you. It's a possibility, but not a strategy. Then you have the new kids on the block. The online direct-to-consumer lenders. The Rockets, the Better.coms. Their value proposition is speed and convenience. You can apply from your couch at midnight in your pajamas. They've replaced loan officers with slick apps and algorithms. And for that A-paper borrower with a 780 score, it's a dream. It's fast, it's easy, it's efficient. But for the person with a 600 score, you're just getting rejected faster. They've taken the rigid, unforgiving algorithm of a big bank and put it on a faster processor. Their model depends on churning through tens of thousands of applications with minimal human intervention. A complex file, a file that needs a story, a file with a 600 score, that's a wrench in their assembly line. Gums up the works. So, you get a quick, impersonal, computer-generated denial. You're just a data point that didn't fit the model. So if the giants are too rigid, the community players are a maybe, and the tech companies are too automated, where do you go? This brings us to the single most important player in this entire equation for a borrower with imperfect credit, the mortgage broker. This is the secret weapon. A mortgage broker is not a lender. They do not have a giant pile of cash to loan you. Think of them as a financial matchmaker. Or better yet, Think of them as your personal agent, like a sports agent for an athlete. Their job is to represent you, the borrower, and shop your specific financial profile to dozens, sometimes hundreds of different wholesale lenders. These are lenders you've never heard of. They don't have branches on every street corner or run flashy TV ads. Their entire business is working through brokers. And here is the critical difference. These wholesale lenders all have different appetites. Lender A might specialize in loans for self-employed people. Lender B might love veterans using a VA loan. And Lender C might have a niche program specifically for FHA borrowers with credit scores between 580 and 640. A good broker knows this. They know the entire landscape. They know which lender just loosened their guidelines last week, and which one is offering a special on lower score files to meet a monthly quota. But the most important secret they hold is their knowledge of something called lender overlays. This is a term you absolutely must understand. An FHA loan, for example, is insured by the government. The Federal Housing Administration sets the base rules. Officially, the FHA will insure a loan for a borrower with a credit score as low as 580, or even 500 with a larger down payment. So you see that online, you get excited, and you walk into Big Bank USA. They pull your 600 credit score and say, "Sorry, we can't do an FHA loan for you. We require a minimum 640 score." You're confused. You say, "But the FHA website says 580. What you've just experienced is a lender overlay. The bank has added its own, stricter rule on top of the FHA's baseline rule. They have overlaid their own criteria. Why? To reduce their risk even further. Most big banks have dozens of these overlays, creating a minefield of secret rules that get you denied even when you technically qualify for the program. A great mortgage broker's entire job is to navigate this minefield. They know which lenders have the fewest or the most lenient overlays. They can take your 600 score application, bypass the lenders with a 640 overlay, and take it directly to the one who is happy to work with the official FHA minimum of 580. This is the game changer. It's not about changing your financial DNA. It's about taking it to a doctor who specializes in your specific condition. Let me paint a picture for you. Imagine two people, Sarah and Mark. Both make the exact same income. Both have saved up the exact same 3.5% down payment for an FHA loan. And both have a 600 credit score due to some old medical debt. They are financial twins. Sarah does what most people do. She's banked with a huge national bank for 15 years, so she goes to them. The loan officer is polite, takes her application, and a day later she gets a call. "I'm so sorry, Sarah, but the system declined the application due to the credit score. Our minimum for FHA is 640. Work on your credit and let's talk in a year." Sarah's crushed. She gives up. Mark, on the other hand, does his research. He finds a local, highly rated independent mortgage broker. He sits down not with a bank teller but with an expert. The broker doesn't just look at the score. He asks for the story behind it. Mark explains the medical debt. The broker nods and says, "Okay, I get it. We're not even going to bother with the big banks. They'll just waste our time. I work with 3 wholesale lenders who follow FHA guidelines almost to the letter. Lender X has the best rates right now and no overlays on credit scores above 580. Let's package your file to highlight your 2 years of steady employment and the consistent savings you've built. We'll tell your story." 2 weeks later, Mark gets a call from the broker. He's approved. He gets the keys to his house. Sarah's still renting. The difference between Sarah and Mark wasn't their finances. It was their strategy. It was the door they chose to knock on. But finding a true expert broker like the one Mark found, and not just a random person from an online search, is a challenge in itself. Picking the wrong broker can be just as disastrous as going to a big bank. There's a specific set of questions you have to ask, a vetting process you must follow, to separate the pros from the pretenders. And that's exactly what we need to break down next. So you're standing at a fork in the road. On one path, there's a massive impersonal bank that sees you as a number. On the other, a sea of independent mortgage brokers, all promising you the world. You've correctly identified that a great broker is your best shot. But choosing the right one is like navigating a minefield. One wrong step and your homeownership dream blows up. The key isn't just finding a broker, it's finding the right broker. And to do that, you need to stop thinking like a borrower and start thinking like a hiring manager. You are about to interview candidates for the most important financial position in your life. This isn't a conversation, it's an interrogation, and you need the right questions. Let's arm you with the 5 critical questions that will instantly separate the expert advisors from the slick-talking salespeople. You can do this over the phone, in person, or via email. Write these down. Memorize them. Do not proceed with anyone who cannot answer these 5 questions to your satisfaction. Question number 1, and it's the most important. What percentage of your clients in the last 12 months had a credit score under 640? Pay close attention to their reaction. A bad broker will get defensive or vague. They'll say something like, "Oh, we help everybody. We don't really track that." That is a massive red flag. That's the equivalent of a heart surgeon saying, "Oh, I do a little bit of everything. Knees, brains, hearts, it's all the same." You don't want a generalist. You need a specialist. Your 600 credit score file has nuance. It has specific requirements. It needs a broker who lives and breathes FHA guidelines, who knows which lenders are comfortable with manual underwriting, and who isn't scared when they see your score. A great broker, on the other hand, will answer with confidence and specificity. They'll say something like, "That's a great question. About 40% of my business is working with clients in the 580 to 650 range. It's my specialty." The biggest hurdles we usually face are documenting income and sourcing the down payment, but we have specific strategies for both. Do you see the difference? One is a sales pitch, the other is a diagnosis from an expert. You want the expert. Question number 2. How many different wholesale lenders are you contracted with? And can you name 2 or 3 that are particularly strong for a borrower in my situation? This question is designed to test the depth of their toolbox. A broker is only as good as their network of lenders. If they only work with 5 or 6 lenders, they're not much better than a small bank. They have limited options. When one of those lenders says no, they might not have a plan B or a plan C for you. A weak broker will give you another vague answer. "We work with all the best ones." That means nothing. A strong broker will light up. They'll say, "We have access to over 60 lenders." For your specific profile with a 600 score, the first places I'd look would be United Wholesale Mortgage because their FHA guidelines are very forgiving, and maybe a lender like Angel Oak, which specializes in non-traditional loans if we need to go that route. We'd compare their rates and fees side by side to see what makes the most sense. This demonstrates 2 critical things: they have a wide array of options, and they are already thinking strategically about your specific file. They're not just throwing it against a wall to see what sticks. They're performing surgery with a scalpel. Question number 3. What does your communication process look like once we start an application? Who will be my main point of contact? And what is your guaranteed response time? The mortgage process is not a walk in the park. It is a marathon of anxiety. There will be moments where you are confused, stressed, and need answers immediately. The absolute worst thing in the world is sending an urgent email to your broker and hearing nothing but crickets for 48 hours. This question sets the expectation for communication from day 1. A broker who doesn't have a good system will stumble here. They'll say, "Oh, just call the office, someone will help you." Or, "Don't worry, we'll be in touch." That's a recipe for disaster. That means you're going to be passed around from assistant to processor, never knowing who is actually in charge of your file. A top-tier broker will have a polished, reassuring answer. "You will work directly with me and my loan processor, Jessica. We are your dedicated team. You will have my cell phone number. We have a firm policy of returning every call and email within 4 business hours, but usually it's much faster. We also send out a weekly update email every Friday, even if there's no new information, just so you know exactly where we stand and what to expect for the week ahead." This is the sound of professionalism. This is the sound of a well-oiled machine that is built to reduce your stress, not add to it. Question number 4. How are you compensated? And can you show me exactly where your fees will be on the official loan estimate document? Let's talk about money. You have a right to know how the person advising you is getting paid. This isn't a rude question. It's a smart one. You need to know if they have an incentive to steer you toward a loan that benefits them more than it benefits you. The wrong answer is anything evasive. "Don't worry about that, the lender pays us." Or, "It's all just part of the closing costs." This lack of transparency is a huge warning sign. They should be able to explain their compensation simply and clearly. The right answer sounds like this: "I'm glad you asked. We are a broker, so we get paid by the wholesale lender that funds your loan. This is called lender-paid compensation. It's a set percentage of the loan amount, and it's the exact same percentage regardless of which lender you choose or what interest rate you get. This means my only incentive is to find you the absolute best loan because I get paid the same either way. When we get your loan estimate, I'll point you to page 2, section A, origination charges, and you'll see our fee listed there in black and white. Total transparency. This is the broker you want. They are confident, honest, and they treat you like an intelligent partner in the transaction, not a mark. And finally, question number 5. This is the master key. This is the one that separates the veterans from the rookies. What is the single most common reason a loan for someone with my credit profile gets denied at the last minute? And what is your specific plan to prevent that from happening to me? A rookie who has only closed a few easy loans will have no idea how to answer this. They'll give you a platitude. Oh, that won't happen. We'll get it done. That is pure naivety. Things go wrong. An experienced broker knows this. They have the scars to prove it. They've seen deals fall apart on the closing day. An experienced elite broker will likely pause for a second thinking. Then they will give you a specific tactical answer. Honestly, for a 600 score FHA file, the two biggest deal killers are last-minute credit changes and issues with verifying employment. So here's our plan. First, before we submit your final file to the underwriter, we run a soft pull of your credit. This doesn't affect your score, but it tells us if any new accounts or debts have popped up that you might have forgotten about. Second, I'm going to counsel you very heavily on not changing anything in your financial life. Don't buy a car, don't open a credit card, don't even buy a mattress on a payment plan until after you have the keys. Third, we get your full employment verification done at the very beginning of the process, so there are no surprises with the HR department a few days before closing. That answer is gold. That is the sound of experience. That is a professional who doesn't just hope for the best. They plan for the worst. They identify the landmines before you ever step on them. Finding the right broker isn't about finding a friend. It's about finding a warrior who will go to battle for you. These 5 questions are your litmus test. They will expose the weak and elevate the strong. Don't be afraid to ask them. The person who will be handling the largest financial transaction of your life owes you clear, confident answers. Once you find that person, once you find that broker who aces this interrogation, you've found your guy. You've found your advocate. And now you're ready to take the first real tangible step toward buying a home. You're ready to get pre-approved. But this is where another massive trap lies. Many people think a pre-qualification and a pre-approval are the same thing. They are not. One is a worthless piece of paper based on a 5-minute conversation. The other is a golden ticket, a weapon that makes real estate agents take you seriously and gives you the power to make a winning offer. Understanding the difference and demanding the right one can be the difference between getting your dream home and facing brutal rejection over and over again. But it's not just about getting the right piece of paper. It's about navigating a minefield. Because once you step into the arena with a 600 range credit score, you become a target. A target for predatory practices, hidden fees, and bad advice that can cost you tens of thousands of dollars over the life of your loan. There are traps laid out for you at every turn, designed to take advantage of your eagerness and your perceived lack of options. Today, we're going to disarm 3 of the most dangerous ones. The first trap is the one that sounds like the best advice you could possibly get. Shop around for the best rate. It's what every financial guru tells you. And for someone with a 780 credit score, it's fantastic advice. But for you, it can be a self-destruct button. Here's why. Every time you formally apply for a mortgage with a new lender, they perform what's called a hard inquiry, or a hard pull on your credit report. And every single hard pull can knock your score down by a few points. It might only be 3 points, maybe 5. Doesn't sound like much, right? Wrong. When your score is 600, you are living on a knife's edge. A 5-point drop could be the difference between qualifying for an FHA loan at 580 and being denied. A 10-point drop from applying to just 2 or 3 lenders could push you out of a program entirely, or saddle you with a significantly higher interest rate and mortgage insurance premium. Think about someone we'll call Jessica. Jessica had a 615 score. She was so excited. She got pre-approved by her local bank. But her friend told her, don't take the first offer. Shop around. So she did. She went online and applied with 3 big-name digital lenders. 1, 2, 3 hard inquiries. Then she tried a credit union. For hard inquiries. Within 2 weeks, her score had plummeted to 590. The original bank that pre-approved her? They ran her credit again before finalizing the loan and had to deny her. The other lenders were now offering her garbage rates because she was a riskier borrower. By following common sense advice, she torpedoed her own dream. So what's the solution? You don't go in blind, but you shop smart. The system does have a small safeguard. Credit scoring models know that people shop for mortgages, so they're supposed to bundle multiple inquiries for the same type of loan into a single event, as long as they occur within a short time frame, usually 14 to 45 days. The problem is, you don't know which scoring model your specific lender is using, and you can't risk it. The real pro move is this. First, you find a mortgage broker. Not a loan officer at a bank. A broker. They work with dozens of wholesale lenders. You apply once with the broker. They do one hard pull on your credit. Then they take your single application and single credit report and shop it to all of their lending partners on your behalf to find you the absolute best deal. They do the shopping for you with only one hit to your credit. Or, if you insist on doing it yourself, you get pre-qualified with multiple lenders, which is based on a soft pull that doesn't affect your score. Only when you've compared their estimates and chosen a winner do you formally apply for that full pre-approval. Never, ever let multiple lenders pull your credit until you're almost certain they're the one. The second trap is the junk fee jungle. Lenders know that when your credit is low, you feel like you have less leverage. You're just so grateful to hear the word approved that you'll sign anything. And some, not all, but some lenders will use this to bury you in fees. When you get a loan estimate, you'll see a section called loan costs or closing costs. Some of these are legitimate, third-party charges, like the appraisal fee or the title insurance. But others are pure profit for the lender, disguised as official-sounding charges. This is where they get you. You'll see an origination fee, which is fair. That's how they get paid. But then you might also see an underwriting fee, a processing fee, an application fee, a rate lock fee, and a loan commitment fee. Suddenly, you're being charged 5 different times for the same essential service. Creating the loan. Let's talk about a guy named Michael. 600 score on the dot. He got approved for a $250,000 loan. He was ecstatic. He glossed right over the fee section of his estimate. He ended up paying over $5,000 in lender fees alone. His friend, who had a 750 score and used a different lender for the same loan amount, paid just $1,500. Michael paid an extra $3,500, a bad credit tax, because he was seen as an easy mark. That was money that could have been a new water heater, a fence for his dog, or 6 months of his car payment. Instead, it just padded his lender's bottom line. Here is your defense. When you get a loan estimate, you must go through it with a fine-tooth comb. Put it side by side with an estimate from another lender. Circle every single fee in Section A, the origination charges. And then you pick up the phone and you ask your loan officer, "Can you explain what this underwriting fee is for? I thought that was part of the origination charge." Ask, "Is this processing fee negotiable?" Ask, "Why am I being charged an application fee when other lenders don't?" You must question everything. Many of these fees are completely arbitrary. They exist because people don't ask. By asking, you signal that you are not an easy mark. You might be surprised how many of those fees magically disappear when they realize you're paying attention. The third and most insidious trap is the PMI prison, private mortgage insurance, or, on an FHA loan, the MIP mortgage insurance premium. It's insurance you are forced to pay for, that protects the lender if you stop making your payments. It offers zero benefit to you. And with a 600 credit score, this is not a small fee. It is a financial boa constrictor wrapped around your monthly payment. The cost of PMI is directly tied to 2 things: your down payment amount and your credit score. The lower your score, the higher the risk to the insurer, and the more they charge you. Let me put this in real numbers. On a $300,000 house with 5% down, a borrower with a 760 credit score might pay $90 a month in PMI. But a borrower with a 600 credit score? They could be looking at $250 or even $300 a month for the exact same loan. That's an extra $200 every single month flushed away. Over 5 years, that's $12,000. $12,000 you paid to protect the bank, all because of your credit score. That extra cost shrinks your purchasing power and can make an otherwise affordable home completely out of reach. The solution here is to understand your options because you have them. First, you need to understand the fundamental difference between FHA and conventional loans. With a conventional loan, your PMI will automatically fall off once your loan-to-value ratio hits 78%. You can also request to have it removed at 80%. But with an FHA loan, if you put down less than 10%, that mortgage insurance premium is on there for the entire life of the loan. 30 years. The only way to get rid of it is to refinance into a conventional loan later. That is a massive critical difference. Second, you can ask about something called lender-paid mortgage insurance or LPMI. This is where you accept a slightly higher interest rate for the life of the loan, and in exchange, the lender covers the cost of the mortgage insurance. You have to do the math carefully. Sometimes, especially if you don't plan on staying in the home for 30 years, paying a slightly higher rate can result in a lower monthly payment than paying that massive PMI premium. It's a trade-off, but it's an option you need to have your lender calculate for you. Avoiding these traps, the rate shopping death spiral, the junk fee jungle, and the PMI prison is more than half the battle. This is the inside knowledge that separates the people who get a fair deal from those who get taken for a ride. But even with all this knowledge, you are still at a disadvantage if you try to go it alone. The system is complex by design. To truly level the playing field, you need to build a team. You need an advocate in your corner, because with a 600 credit score, you're not just buying a house. You're fighting for it. And the most powerful weapon you can have isn't a type of loan or a government program. It's a person. And that person is not just one person. It's a team. It's your personal Justice League for the world of real estate and finance. You need to assemble a crew of specialists who don't just see a number, they see a person with a goal, and they have the specific tools and experience to make that goal a reality. First, and most importantly, you need a mortgage professional. But not just any mortgage professional. For most people with a 600 credit score, walking into your big national bank, the one you've had a checking account with since you were 16, is one of the fastest ways to get a hard no. It's not because the loan officer is mean. It's because that bank often has one set of rules, one tight credit box they have to stay in. They put your numbers into their system, the computer says no, and that's the end of the conversation. It's demoralizing and it makes you feel like the door is shut forever. But it's not. You just knocked on the wrong door. What you need is a mortgage broker or a loan officer at a direct lender that specializes in government-backed loans. What's the difference? A loan officer at a big bank works for one bank. They have one menu of products. A mortgage broker, on the other hand, is like a personal shopper for home loans. They have relationships with dozens of different lenders, big ones, small ones, niche ones you've never even heard of. They know that Lender A is great for self-employed borrowers. Lender B has a special program for first responders, and Lender C. Lender C is comfortable with FHA loans down to a 580 credit score, as long as the borrower has a stable job history. The broker's job isn't to fit you into their box. Their job is to find the box that you already fit into. They are your financial strategist. They will look at your entire file, your income, your job history, your savings, the story behind your credit score, and they will know which lender to present it to. They know how to package your story. They can call the underwriter directly and plead your case, explaining that the medical collection from 3 years ago was a one-time crisis and not a pattern of behavior. The automated system at the big bank can't do that. Finding this person is your number one mission. So how do you do it? You start by asking for referrals. Talk to real estate agents and ask them, who is the best loan officer you know for helping buyers with less than perfect credit secure an FHA loan? Agents know. They know who can get the tough deals done and who just wastes everyone's time. When you interview a potential broker or loan officer, you ask them direct questions. What percentage of your clients have a credit score between 600 and 640? Which lenders do you work with that are most friendly to this credit profile? Have you successfully closed a loan for someone in my exact situation in the last 90 days? If they can't answer those questions with confidence and specific examples, they are not the one for you. Keep looking. This person will become the quarterback of your financial team. Next, you need your boots on the ground, a killer real estate agent. Again, not just any agent. You don't want the agent who only deals in million-dollar luxury condos. You need an agent who lives and breathes the world of first-time homebuyers in FHA, VA, or USDA financing. Why? Because these loans have specific property requirements. An experienced agent knows an FHA appraisal red flag when they see one, like peeling paint or a leaky faucet, and they can advise you before you waste money on an inspection. More importantly, they are a master negotiator for things that matter to you. A buyer with a 600 credit score often doesn't have an extra $10,000 sitting around for closing costs. A great agent understands this. They know how to write an offer that asks the seller to contribute towards your closing costs, what's known as seller concessions. They know how to structure the deal to protect your limited cash. They are your advocate in the trenches, fighting to get you the best possible terms on the actual house itself. They understand that for you, getting the seller to pay for a 1-year home warranty isn't a luxury. It's a critical safety net. When you interview agents, ask them, how many FHA buyers have you represented this year? Explain your strategy for negotiating seller concessions in the current market. Their answer will tell you everything you need to know. These two roles, the mortgage broker and the real estate agent, are your offense. They're the ones moving the ball down the field. But you also need a coach. Someone on the sidelines helping you train, strategize, and get in the best possible shape. This is your secret weapon. A HUD-approved housing counselor. So many people have never heard of them, and it is a tragedy. A HUD-approved housing counselor is a trained professional, typically working for a nonprofit organization, whose entire job is to help people like you understand and navigate the home buying process. And in most cases, their services are free or very low cost. This is not a credit repair scam. These are legitimate, government-vetted experts. You can find a list of them in your area on the official HUD website. What do? They can pull your credit report with you and go through it line by line. They can help you write dispute letters for errors. They can help you create a realistic budget and a savings plan for your down payment and closing costs. They can educate you on all the different loan types and down payment assistance programs you might qualify for. They are an impartial, expert guide who has no commission on the line. Their only goal is your success. Imagine this. You meet with a housing counselor. They help you identify a small $500 collection account that's dragging your score down. You negotiate a pay-for-delete with the collection agency. You pay it, it gets removed from your report, and your score bumps up from 600 to 625. That might not sound like much, but that 25-point jump could be the difference between a denial and an approval. It could be the difference between an interest rate of 7.5% and 6.9%. Over 30 years, that single change, guided by your housing counselor, could save you tens of thousands of dollars. So this is your team. Your trifecta of triumph. The mortgage broker is your financial strategist, finding the right loan and lender. The real estate agent is your field general, finding the right house and negotiating the right deal. The housing counselor is your coach, getting you prepared for the game and making you a stronger candidate. With this team in place, the entire dynamic shifts. You're no longer a loan applicant with a scary credit score, begging a bank for a chance. You are the CEO of your own home buying journey, with a board of expert advisors guiding you every step of the way. You have a plan. You have a strategy. You have advocates who believe in you and have the specialized knowledge to turn your dream into a set of actionable steps. They will be the ones to tell you that with a 600 score, your debt-to-income ratio is now the single most important number in your life. They'll be the ones to explain why you absolutely cannot make any large purchases or apply for new credit while you're in this process. They will prepare you for the intense scrutiny your bank statements will be under. Getting the team is step 1. Getting the pre-approval letter from your broker is step 2. And that letter, that piece of paper, is the key. It's the key that lets you walk into a house and make an offer. It's the proof that you are a serious, qualified buyer. It's the culmination of all your hard work. And holding it in your hand is one of the best feelings in the world. But it is not the finish line. Not even close. Getting pre-approved is like winning the qualifying round. The real championship match, the grueling, stressful, and often confusing process of going from an accepted offer to getting the keys in your hand, is still to come. The underwriting process is a minefield, and with a 600 credit score, you have to step very, very carefully. One wrong move, one financial misstep during that critical 30 to 45-day period can blow the entire thing up, even with the perfect team in your corner. So let's talk about those mines. Let's talk about the specific financial grenades you can accidentally pull the pin on during this critical time. Because once you're under contract and that loan application is in the hands of the underwriter, you are living in a financial fishbowl. Every single move you make is being scrutinized. So I want you to burn this into your brain. These are the cardinal sins of the mortgage underwriting process. Commit any one of these, and you risk getting that dreaded phone call from your loan officer. The one that starts with, "I'm so sorry, but..." First, and this is the big one, you do not, under any circumstances, apply for new credit. I don't care if it's a credit card offering 0% interest for 18 months to buy your new living room furniture. I don't care if it's a store card that will save you 10% on a new lawnmower. Do not do it. Every time you apply for credit, it triggers a hard inquiry on your credit report, which can ding your score. With a 600 score, you have 0 points to spare. More importantly, if you're approved, that new credit line and potential debt has to be factored into your debt-to-income ratio. The underwriter approved you based on a snapshot of your finances. You just change the picture and they will see it. They pull your credit again, sometimes on the day of closing, and if they see a new account, the entire process grinds to a halt. Second, do not make large, undocumented cash deposits into your bank accounts. This is a massive red flag for underwriters. They aren't being nosy. They're legally required by federal anti-money laundering laws to source all large deposits. That $20,000 your uncle gave you from his safe to help with the down payment? To the lender, it looks like an undisclosed loan you'll have to pay back, which would destroy your debt-to-income ratio. If you're receiving a gift, it must be meticulously documented with a formal gift letter, a copy of the giver's bank statement showing they had the funds, and a paper trail of the transfer. Mattress money is the kiss of death in a mortgage application. Every single dollar has to have a story, and that story has to be written on paper. Third, do not change jobs. Your lender approved you based on the stability and history of your current employment. If you suddenly switch employers, even if it's for a raise, you introduce a massive variable. The underwriter has to re-verify everything. If your new job has a probationary period, which most do, you are very likely going to be denied. Full stop. The lender needs to see a track record, usually at least 30 days of pay stubs from the new job, before they'll even consider moving forward. By then, your closing date will have passed and your deal could be dead. Stay put. Wait until after you have the keys in your hand to make any career moves. Fourth, do not co-sign for anyone. Your brother needs a car and asks you to co-sign the loan? You have to say no. It's a hard conversation, but it's a necessary one. The moment you co-sign, that entire debt legally becomes yours in the eyes of the lender. That $500 a month car payment goes directly into your debt-to-income calculation, even if you never personally make a single payment. It can, and often will, be enough to push you over the qualifying threshold and result in a denial. Fifth, don't miss any payments on your existing debts. This sounds so basic, but in the chaos and stress of buying a home, it's easy to let a credit card due date slip by. A single 30-day late payment reported during the underwriting process can be catastrophic. It can plummet your score below the 580 or 620 minimum, and it shows the underwriter that you're struggling with your current obligations. Right when you're asking to take on the biggest debt of your life. Set everything to autopay. Double-check your accounts. Protect your score like it's a newborn baby. Sixth, and this is the classic horror story you hear about all the time. Do not go out and buy a car. You get the pre-approval letter, you feel invincible, and you think, new house, new car, right? Wrong. This is the single fastest way to kill your mortgage deal. It combines the sins of applying for new credit and taking on a massive new monthly debt. A $700 car payment doesn't just affect your DTI. It nukes it from orbit. I have personally heard stories of people who were denied on the day of closing because the lender did their final credit pull and saw a brand new auto loan. They had the moving truck packed and had to tell them to turn around. Don't let that be you. And the seventh sin, don't be slow or unresponsive to your lender. The underwriter will likely come back with conditions. These are requests for more information, an extra bank statement, a letter of explanation for a past credit issue, an updated pay stub. When they ask for something, you treat it like a 5-alarm fire. Gather the documents immediately and send them over. Every day you delay is a day the underwriter puts your file at the bottom of the stack and works on someone else's. Being prompt, organized, and polite makes their job easier and shows you're a serious, responsible borrower. So you've navigated the minefield. You've avoided the sins. You get the magic words. Clear to close. You do the final walkthrough of the house, you sign a mountain of paperwork, and then you get the keys. It's an incredible moment. But I need you to understand something. For you, the person who started this journey with a 600 credit score, this is not the finish line. It's the starting line of a whole new race. Getting the loan was the hard part. Now begins the most important part. Proving you deserved it and building a better financial future. Your number one priority from this day forward is to make your mortgage payment on time, every single time. No exceptions. A mortgage is the most powerful credit building tool on the planet. A consistent, on-time payment history on a large installment loan like a mortgage will cause your credit score to rise faster than almost anything else. Within 12 to 24 months of perfect payments, combined with continuing to manage your other debts wisely, you're going to see that 600 score climb to 650, then 680, then break into the 700s. And that's when the next chapter begins. The FHA loan with its expensive mortgage insurance was your ticket into the game. It was a fantastic tool that got you into the house. But it's not meant to be a forever loan. Your goal is to refinance. Once you have a credit score in the 700s and you've built up at least 20% equity in your home, through a combination of paying down the principal and home price appreciation, you can refinance out of that FHA loan and into a conventional loan. This is the power move. A conventional loan will have a better interest rate and, crucially, no private mortgage insurance, which could save you hundreds of dollars every single month. That's money you can use to pay the house off faster, invest, or save for your kids' college. This is how you turn a moment of opportunity into a lifetime of wealth. It starts with the discipline to get your foot in the door with a 600 credit score. It continues with the discipline to avoid the pitfalls during underwriting. And it culminates in the discipline to use your new home as a vehicle to fix your credit, build equity, and achieve a level of financial security you never thought possible. So, can you get a home loan with a 600 credit score in the US? The answer is a resounding, unequivocal yes. It's not easy. It's not simple. It requires a team, a strategy, and a level of personal financial discipline that most people don't have. But it is absolutely possible. But that's not the real question, is it? The real question is, are you ready to do what it takes? Are you ready to face the rejections, to write the letters of explanation, to live in that financial fishbowl, and to treat your finances with the seriousness they deserve? Are you ready to not just get the keys, but to use them to unlock a better future, to build your score, to build your equity, and to create a foundation of generational wealth? Because if you are, then this isn't just a dream. It's a plan, and you can absolutely make it happen.